Conversation forward. We've got Sanjiv Bhasin joining in on the show right now. Sanjiv, hi, morning. I believe chilly winds back in New Delhi with fresh snowfall in the Himalayas.
Yeah, good morning. Well, Aisha, very pleasant weather. We were out yesterday also and there are a couple of gatherings, but very pleasant weather. Far cry from the 3 degrees, which we saw in mid-January and so on. But yes, very pleasant weather. Very good time to be here. It's not all that cold and you would really enjoy the sun in the afternoon. But that's what the market is all about, sunny days. And the left out feeling being humongous with FIs. They are back now. The Dow is above 39,000, the Nasdaq above 16,000, and I think we should be looking at slightly higher levels, though consolidation in this week of derivative expiry, with I think 22,000 now being the base for this expiry on the Nifty.
So what's going to lead the markets higher or keep it amidst bright sunshine? Will it continue to be autos on the upside, and you think private banks will continue underperformance?
No, we've been contrarian. We think we've taken chips off the auto block. We've added banks and we've added select metal stocks. You know, this whole Japanese rally, which is now taken the Nikkei closer to 40,000, is being led by metals. And, the Nippon Steels of the world. We have to realize that China comeback, the whole impetus on growth has to be very co-sync with commodities. And I think the dollar is definitely headed lower, which will only mean good news. In India also, if you see the capex side, I think there is going to be a very strong demand as far as construction activity and the ancillaries. So commodities is something which we are very bullish, and hence we continue to have overweight on the metal stocks.
Continue to have overweight on the metal stock, but just taking stock of Asian Paints, that's one portfolio stock that has been just blue chip and compounding beautifully for a lot of investors. But today, CLSA has gone ahead and downgraded the counter to to a sell now from underperform earlier. The target has been cut sharply to 2,400 rupees versus over 3,200 rupees that they had expected earlier. They are talking about the increase in competition, and they're saying that the company, despite being the leader, is not going to be immune to either the near-term growth headwinds as well as the margin. So keep an eye out on all of that, and they've cut the targets and the estimates by 8 to 10% for the next couple of years. Mr. Bhasin, what's the view on Asian Paints? Those long-term investors that are holding the stock, should they look at booking some of the profits, or is it a time to perhaps add more?
Well, it's a glass half full, half empty. Anisha, I expect March to be a difficult month as far as the momentum stocks go. I'm not foreseeing, too much of, I'm forcing too much of froth over there. Hence, I would be in defensive names like HDFC Bank and Asian Paint, where you don't get these opportunities very often. You cannot have the capex expenditure, the home building at such a pace, and Asian Paints not being part of it. 53% of the decorative segment. The problem is that now most of the FIs have been underweight India on the momentum side. So now they are chasing defense stocks, they're chasing PSU banks, they're chasing anything with a tag of PSU because the left out feeling. So you will sell HDFC Bank and CLS and Asian Paints. I still think Asian Paints as a pedigree stock will give you an opportunity. And if you do get it around 2,700, 2,800, you must add. So doing a SIP in HDFC and Asian Paint is an excellent strategy. We have HDFC Bank in our coverage. We've used this last month only to add HDFC Bank. When there is such a big herd of selling, it generally gives you a very sweet long-term opportunity. And like I said, I'm foreseeing a lot of volatility in March, which could be on the negative side. Hence, HDFC Bank will stand out over there.
Okay, keep it safe. Stick it out with HDFC Bank and Asian Paints. They're actually giving you a very stable opportunity. That's the word coming in from Sanjiv. But an interest bullish on Vodafone in any case. But what about Indus Tower?
So Aisha, I gave a buy call on Indus Tower on the same pretext that if Vodafone is going to be raising cash, then the biggest receiver is Indus Tower. And you saw Indus Tower's quarterly numbers. They were a blowout. So that 200, 210 is 240. I don't rule out 275 coming very fast in this. And we are aware that their business their whole catalyst business is doing extremely well. And what they had written down for Vodafone is now being receivable. So they said the last 4 quarters actually money has come in, and slowly but surely a big infusion will mean that Indus Tower gets a lion's share of the money which was pending, and that streamlines the business. That is what Kumaramangalam is telling you. Plus, you have the added news of government saying we want stability on their entry into 5G, and we have no plans to make a killing from the investment we made at 10 rupees. I think Indus Tower and Vodafone both are accumulate on declines, and that's been our stand over the last 3 months.
Okay, accumulate on declines, that's the word coming in. But from the frontline index, of course, these private banking names have underperformed. Mr. Bhasin, you talked about HDFC Bank, how you're still very positive on it. But what about Kotak, Axis, ICICI of the world?
Yeah, so Anisha, it's a strange dichotomy. The private banks, which actually should be getting the credit for expansion of margins, better, NPA performance, they are being neglected at the cost of the PSUs. I am of the opinion that you can't get a better entry point in the whole market. The best play now is large cap private banks. And like you said, I would say ICICI, Axis, HDFC and Kotak in that order are going to stand out. Now, time is on your side and patience. That is what is needed. Take some chips off the PSUs across the board except ONGC, which is our top pick, and GAIL. But otherwise, I find no value in PSUs at this price. All you're seeing is mutual funds and FIs, the left out feeling getting humongous, and they are selling some of the private banks or whatever their quasi plays at the cost of getting into that. It can't be a better moment to do a SIP in some of the large private banks. You'll be richly rewarded in the near term.
Brings me to the entire urban consumption play that has done very well. Now, given you are saying that don't be in momentum or at least stop chasing the momentum, is it the time that all that luxury play and the urban consumption themes also merit a profit booking?
Well, yes and no. You'll have to see selective pockets, Anisha. I am very bullish on consumer stocks, and I think the worst is behind. So two stocks which we've been accumulating is Bata and Patanjali. Look, the rural masses are gaining. There has been the MSP, the other issues, rainfall, and you cannot have Hero Honda, Eicher, and Bajaj at all-time highs, and Patanjali and Bata not participating. Look, the brand evidence and the growth aspiration to get onto better consumer names, which is going to drive Bata to be one of the best plays. As you know, Bata is now, subcontracts their business. Their liability franchise is almost nil, and the margins are going to accrete. Same is the case with Patanjali. I think it is going to get into more market share from lever. And if you see across the board, I go to smaller cities and all, Patanjali is more evident than any of the large FMCG plays. So as a disclosure, we've upped our guidance. We think these stocks are going to outperform along with private banks and select and metals. These are three phases which are contrarian and which are not in the popular list, but we don't want to be in the popular. We are taking money chips off the table in a large part of the PSUs. We think the rally has been overdone. This is the time to be in select stocks which have very, very good risk reward like we named.
Why Bata? Why not Campus? Why are you buying Patanjali and why are you not buying Britannia?
Simple logic, Nikunj. I think Bata as a market cap, as a market share is only going to grow, and the aspiration to move from Campus to Bata is very, very evident. Secondly, Bata's expansion on, like I said, their change in model of contract sourcing has been a very, very big plus point as far as labor and union things. And I think Bata fits the bit perfectly for a comeback in rural incomes and spending capacity. Patanjali purely on the fact that their brand expansion, their margins, and the type of businesses which they are in. I think in the the acquisition of Ruchi Foods and so on, that is going to see very, very handsome comeback. I am very, very overweight on both these stocks, and we don't want to chase 60 times at Britannia. We think Britannia is a good fit to buy, but I would be putting more money in, like I said, in both these names. I'm not bearish on Britannia, by the way. I think Britannia becomes a very good target for being one of the most sought after takeover games because of their inherent low equity base of a promoter. And that could be the card on the cards over a period of time. But Nestle continues to be my top pick in the large caps, and Marico, and Patanjali and Bata in the mid and small cap.
Bear in mind that we're just discussing this on Swadesh right now, just when we were there, which is that folks just think about it, and that's just my personal view. 70% of the India accounts for 30% of the consumption. 30% of India accounts for 70% of the consumption. Within that, you got right at the top of the pyramid luxury. That's not even 2%. So while markets are focusing on the ultra luxury player, and Ethos has done well, a landmark car has done well, anything which has got to do with luxury. So I think that luxury trend is not going to change, but there the base effect would kick in. But for the broader mass market products, 2021 to 2022, first you got hit by COVID. You had an unequal recovery. Then you got hit by inflation. Then you got hit by monsoon. So interestingly, they've had one issue after the other in terms of normalization. Now that inflation has come under control, seemingly under control, the benefit of productivity gains and infrastructure spends and railway capex, all of that has started trickling in. The huge base effect what we saw because of revenge shopping, that is also behind us. Some of these categories will start making a comeback. The early evidence actually has started indicating to us, whether you look at two-wheelers or you look at semi-urban data. So what Bhasin Saab is saying is precisely that point we are discussing in Swadesh, like QSR, footwear. These are categories which are not compulsive categories, but these are categories which are aspirational categories which will do well when the base effect of inflation starts to wane away, and when you have more disposable income, which I think is kicking in after 3 or 4 years of these extraordinary situations. एक साल monsoon था, उसके पहले inflation था, before that it was COVID. So these factors I think are something which have really dented the pockets, some of these niche pockets. So in that same spirit, Bhasin Saab, I think V-Mart retail, D-Mart, they should also come back.
Correct. I think DMart, but that we are playing through Reliance Retail. And I think Reliance Retail itself suffices. By the way, Reliance has moved from that 2,300 to 3,000 on the back that retail, Geo ARPUs, and their other, solar energy and defense plays, their EV, their other, businesses are doing extremely well. So we'd rather pay that to Geo and Reliance Retail. We've had a buy on Geo from 230 levels and Reliance from 23 levels as a disclosure, and that has played out very well. But like you said, Nikunj, the real money will be made in these names which have a marquee name and which have underperformed for whatever unforeseeable, reason. And I think Patanjali, Bata, and Nestle at the top will fit in that bracket perfectly.
All right, Bhasin Saab, appreciate your time. Thank you for joining us. Patanjali